Welcome to Trends with Benefits, a podcast by Van Eck with a forward-looking perspective. We explore new ways of thinking about the markets, investing, work, and life. Here's your host, Ed Lopez.
Growth, value, momentum, inflation, the Fed, millennials, meme stocks. There are a host of cross currents in today's markets. And who better to talk to about these than somebody who is in the market, somebody who opines on it on a regular basis. And that person is my guest today, Joe Terranova, Senior Managing Director at Virtus Investment Partners. You may know him best as a CNBC ensemble member, appearing regularly on the Halftime Report and Squawk Box. He's also an author of a book from a few years ago, Buy High, Sell Higher, which I think has a lot of relevance still in today's markets. So, Joe, welcome. I'm really stoked to be able to chat with you.
Ed, thank you so much for having me. I'm looking forward to the conversation.
So, maybe I'll just start out with, I want to start with your book, because I think the subtitle is something like Buy and Hold is Broken. Do you believe that?
No, no, I don't. I don't. And, I'm one that is willing to admit the mistakes that I have made. We all make a tremendous amount of mistakes in our personal and professional lives. I'll tell you the backstory on that, Ed. Grand Central Publishing, who did just a fantastic job with Buy High, Sell Higher, they wanted something more than what I had suggested and really strongly advocated for, which was the title, Buy High, Sell Higher. Well, they were like, no, we want something more than that. The world has changed. Warren Buffett keeps saying, buy and hold. So they came up with this, buy and hold is dead. And I so regret it, because no, I don't believe that is true in any capacity. I pushed back on it at the time. I wish I would have pushed back on it further. So let this be on your show, Ed, my public apology to everyone for the misplacement of that title. Didn't belong in the book. Don't believe in it. And I'm sorry for it.
That's an unexpected answer, but that's awesome. Thanks for being honest about that.
It's candid.
Yeah, totally. Well, we'll go back to that a little bit and some of the influences that really contributed to your book. I mean, this is the first time I've interviewed you, so if you don't mind, maybe I'd love to learn a little bit more about you before we get into all the other market stuff. Starting out your career as a trader, is that what you intended to do when you went to school and thought about what you do when you grow up? Was it becoming a Wall Street type kind of trader kind of guy?
Well, I grew up on Long Island, hence the accent, and grew up in the 80s. And the 80s were about either pursuing some form of an athletic career or going to, follow in the footsteps of Greed is Good and Wall Street, right? That was the flavor of the 80s. So that's exactly, the athletic career, unfortunately, didn't work out for me as planned. And I pivoted quickly, certainly more well-suited coming out of college to pursue a career on Wall Street. I did that, Ed. And it's interesting because I did it in a very traditional capacity. Unfortunately, coming out of St. John's, I didn't have the Ivy League education. I probably didn't have the proper pedigree, if we could use that word, for what Wall Street was looking for to place me in what I was really seeking. I wanted a revenue producing position. I think you would agree with me. Revenue producing positions, that's exactly where you kind of want it to be. So I didn't really go through the front door. I kind of went through the back door. They let me into the Wall Street Club. I first worked for JP Morgan Securities in a role that was incredibly frustrating, tedious, and really operational in its nature. I knew right away this is not where I want to be. I quickly left that position. I went to work for Swiss Banking Corp, worked there for a while. And again, I got to kind of touch that revenue producing position, but not fully. I retreated back to kind of my athletic background. I left Wall Street for a while. A group of individuals that I was friendly with here on Long Island opened a personal training facility in what's known as the Five Towns. Carl Icahn is from there. I met a gentleman in that personal training facility. His name was Mark Fisher. Mark Fisher, I don't know if you know him, Ed. He's very well known within the commodities world, gold, oil. He was a very big trader. And I could see that doing something with Mark professionally would allow me to engineer my own outcome. And that's exactly what happened. I went to work for Mark. I walked down onto the exchange at 4 World Trade Center. I looked around that trading floor. It was the same trading floor you saw in Trading Places with Eddie Murphy. And there was just this energy, right? There was this energy. And Ed, it was almost, I said to someone, it was like the fifth professional sport. You have baseball, hockey, basketball, football. And I felt like, and then there was this trading, speculative investment environment. There was so much energy on the trading floors in Lower Manhattan back in the late 80s and early 90s. And that's where I began pursuing a career of understanding trading and investing. And I think most importantly, understanding risk management, because that's kind of the foundation of everything in terms of my approach to the markets.
You write in your book that you are by nature an introvert. How did you kind of interact in that trading environment?
So I was a unsuccessful pit trader. So a pit trader needs to stand on the steps and scream and yell to the other side of the ring and buy 10 or sell 10 or whatever the case may be. And it just was not in my personality and nature. I was a very shy child. I had some challenges in that sense that I think we better define now in a society that's advanced and understood and nurtured and cared for people with some struggles at a younger age. But I had that. And that kind of limited me in my ability to really engage with others. So that environment was really hard for me. So I failed. I tried twice. I failed. We pulled the plug on it. I didn't get discouraged by it. As Jamie Dimon often says, getting fired doesn't define you. It didn't. There was something different that I needed to be doing. So I kind of stepped back, 30,000 foot view. Okay, let's focus on this risk management. And ultimately, I think it led me to what I believe in more, which is more about long-term successful investing. And I think my personality aligns with that. But yeah, I am a very private, introverted person. And for someone that's on television, I probably you would find that hard to believe.
Talking about your trading career, you have written about how you ended up managing a large number of people, something like 300 traders, managed through various crises, whether it's the Asian crises or 9/11, on some of more of the financial or those limited to financial markets and navigating volatility and managing different traders. I don't know, what have you learned either about yourself as a manager or as an investor in dealing with those kinds of events?
Well, first of all, I think exposure to the futures market shapes you in a way in which you approach risk management and understand that what you might think is not possible in terms of pricing a particular asset, it actually can happen. So I'm just going to use as an example, sugar, which is a commodity that's not highly liquid, not really very much popularized for the financial services industry in terms of speaking about it, but it is something that's traded on an exchange and it is a regulated futures contract. Well, the value of a sugar contract went to one tick. So in 2020, in the spring, when crude oil went negative and people were just astonished by that, I kind of looked at it and I was like, well, okay, I've seen some things like this before. I've seen natural gas go to $20. I've seen that extreme volatility that can occur in the futures market. A lot of time, commodities price as if there actually is going to be a physical expiration on something. I know there's a monthly expiration in the commodities world, right? So in that monthly expiration, owners of the paper asset, they have to liquidate and neutralize their existing position by rolling it forward into a future month. Well, there's other scenarios where a lot of time there's an actual physical expiration where you have owners of whether it's natural gas or oil, they're just saying, we just need to get rid of. We need to just literally get rid of this physical commodity that we're owning. So I think what that did for me was it made me understand the first thing you always think about is how much money you could lose, not how much money you can make. Until this day, that's what I focus on. because it's always understanding that there are the rare instances in markets where you will have an extreme downside. And I think what's important is that you never want to place yourself in that emotional ocean when markets are trading with such a heightened sense of urgency and there's such a precipitous decline, and you're in that emotional ocean where unfortunately a lot of times you're going to make a wrong decision, and that wrong decision might be to liquidate at the very bottom, or that emotional decision might be to add to a position when there's another 20 or 25% further downside coming. So I don't want to say that I'm always playing defense, because that's not what I'm doing, but I'm always measuring risk first before I even begin to think about reward.
So taking that experience and your knowledge of markets, how would you characterize today's market? You know, it's the summer of 2021. How are you thinking about the markets today? Do you subscribe to the idea that perhaps it's overvalued?
Well, there's two ways to answer that. Let's handle first market structure. I think market structure, because of the advancement of technology, is very similar in presenting the type of volatility that you might find in futures markets. So I can relate to the speed of the market, the 2% decline in one day. A lot of that is very relatable for me. That's the structure. In terms of the market itself and long-term investing, which is what I like to focus on a lot, I do a lot of work with advisors around the country. I think there's some things that are very critical to understand. First of all, to ask a question of an individual about their view of valuation, you're not going to get the realistic and candid answer unless you understand the very personal characteristics and the profile of that person. So what's the vehicle for everything that we're doing in the financial services industry? It's called a portfolio. So your portfolio is literally a vehicle that's moving you towards what? Whatever goals and outcomes you're defining in your life. Your portfolio moves you towards that. Now you've got this series of goals and outcomes. And should any portfolio look very similar? Like, Ed, I don't know how you feel about this, but people always say, well, 60-40, give me the right allocation. Well, that's an impossible answer, because your portfolio, it's like my palm print. It's like the fingerprint. It's unique to the individual. So if you have someone that's defined a series of goals and outcomes, and that individual has achieved, you could check the box on all the goals, and that individual has a capital need within the next 6 to 9 months. It does not matter if the S&P is 4,400, 3,400, or 2,400, or even 1,400. The market's overvalued. They have a capital need, and they've achieved the goals and outcomes. If you have another individual that has not achieved any of those goals or outcomes and doesn't have a capital need for the next 3 to 5 years, then the market could be 5,400 for the S&P. And it's not overvalued, because they have to remain committed to being invested. So that's kind of how I think about it. And I think the other way to look at things, which I don't think we do a good job of doing, is understand the law of supply and demand, and understand that law of supply and demand can be applied to what I call paper assets. So if you think about the supply of investable assets available, that supply has diminished greatly over the last 10 years. But now think of the demand for the investable assets. Think about global investors who have seen a significant wealth creation, therefore a need to invest, right? Rising demands. We know that millennials are finally engaged in the capital markets, rising demand. We know Gen Z, as I said before, is going to be the single most financially literate generation of our lifetime and technologically proficient, rising demand. So I think there's this dramatic supply to demand imbalance for paper assets. And I think as a result of that, you're seeing the creation of NFTs, of crypto assets. You're seeing do-it-yourself stocks, a lot of non-traditional assets being introduced, because you've got this dramatic demand that's somewhat unprecedented in the history of financial markets, right? Ultimately, that's where we kind of have to properly measure and understand a secular tailwind that might be existing. But overall, in terms of the perspective of is the market overvalued or not overvalued, that is unique to the individual.
That's a very diplomatic answer. That's true. I totally agree with you in terms of portfolio construction, and that should be unique to the individual.
Well, the other thing to add upon that, Ed, is if you were to say, okay, are there specific areas of the market that are overvalued? The answer would be yes, but even better, the market is doing an efficient job in correcting the overvaluation over the last year. I think we're bearing witness to that. We saw that with hyper growth stocks back in February. You saw that in some of the crypto assets. You've certainly seen that in SPACs. You're seeing a little bit of that excessive valuation being pared back currently here over the last couple of weeks. And even to a certain extent in mega cap technology, you saw that in the fall of 2020. So the market is doing an efficient job of correcting internally whatever perceived overvaluation there might be.
So, right or wrong, people are focused on the equity markets or the S&P just broadly as a barometer when talking about markets. So if you're somebody sitting in cash because you believe markets generally are overvalued, you want to wait for a pullback, what would you tell that person? It's like, don't worry about it. Would you have that person now is a great time to invest?
Well, first of all, let's understand the individual profile. Let's understand the capital need. As I said, all that before. Now, let's say, okay, we've got the individual, doesn't need the money. They have time on their side. Yes, in a very diversified, traditional way, they need to begin to invest in the market. They need to begin to have a lifestyle change as well that's going to encourage them to save and invest more and spend less. I think that's something that is not communicated effectively enough that correlates with your entree into the investment world. The other side of that is you want to create enough capital from the income that you're deriving in whatever mannerism you're doing it to therefore go out and actually invest in markets. I would emphasize being kind of, as I say, often being everywhere versus being there. I think the temptation of the last couple of years is to allocate towards concentration. You began this show by saying growth or value, talking about different strategies. What's interesting right now is I don't think there's ever been a time that I could remember in my 30 plus years having a presence on Wall Street where we need to emphasize diversification more than we need to emphasize it today, and kind of avoiding concentration and looking towards rebalancing opportunities. I think it's incredibly important. I mean, the growth versus value conversation, what are we talking about? S&P growth is maybe outshining S&P value by 4% year to date. I actually did some statistical work where I went back and I looked at the three major equity sectors that we kind of define as growth and value. We looked at technology, financials, and industrials. We went back and we studied from the March 23rd of 2020 intraday low, 2191, right? That's where we bottomed last year during the pandemic, to we ran it through the end of June, through the end of the quarter. What was the performance of the S&P total return, which was somewhere around 96%. And then financials, technology, and industrials were within 2% of each other, 2%, up somewhere around 112% to 114%. So, you've got this dramatic conversation, growth, value, which way do we go? When really the ultimate answer to that is yes. So an individual right now who has not invested, I want them to consider everything. I want them to think about a multi-sectored approach in taxable fixed income that includes municipal bonds, it includes investment grade, it includes bank loans, it includes high yield, which given where we are from a valuation perspective might offer a nice equity replacement. I want them to give consideration to small caps. Yes, they've been underperforming recently. That's a rebalancing opportunity. Mid caps, large caps. You want your opportunities to be technology, healthcare, financials, industrials, consumer discretionary. very diversified manner, avoiding concentration, and even leaning towards having geographic exposure. And that's really the one place so far in the 2021 capital markets where you're seeing the significant underperformance. A lot of that is because of poor COVID trends outside of the US. So you've seen the emerging markets, you've seen Japan, you've seen to a certain extent some European equities where they've underperformed relative to domestic equities. But it's about diversification.
Yeah, yeah. There's always also been kind of a home bias for U.S. investors too, to invest domestically. And I mean, being in the fund business myself, trying to get people to buy into international stocks or emerging market stocks, it's a tough story sometimes, and particularly with headwinds or stories like this week with China cracking down on their markets. And I think some people are going to be loath to go back.
I don't disagree with that. And I'm sure in your advocacy, you've talked about the lost decade and the outperformance of the emerging markets. Everyone seems to do that. And I get, on the part of investors and advisors, when they hear that, they're like, yes, but we have certainly been rewarded by ownership of equities in the United States. I think what's important is there needs to be a fundamental catalyst for a lot of the geographic exposure that you're seeking, a fundamental catalyst to attract capital there. One of the reasons why capital is not attracted geographically outside of the United States is the absence of economies that look like the US economy. I mean, without question, there is no economic equivalent to the United States, okay? The United States is an economy that is undergone an absolutely dramatic transition. We were a bulk economy. We were a tangible asset economy. We valued the piece of machinery, the airplane, the automobile. We don't value that anymore. We value the algorithm, the artificial intelligence, the software program. We're asset light, the intangible asset. We export software and services better than anyone else in the world. We're technologically oriented in our society. Ed, the second leading exporter of technology in the world is Israel. Okay. In addition to that, because we have this technological digital economy, it empowers you and I, the consumer. Consumer balance sheets are in the best shape they've been in the last 30 years. Far better than corporations, far better than governmental balance sheets. And because of technology, you've got this blessing of energy independence here in the United States. So there's no economic equivalent to that in the United States. I think the ultimate fundamental catalyst is when you begin to see an embracement and an incentivization on the part of local economies to move their economy to something similar to what we have benefiting us here in the United States, which is a real digitally oriented economy. I mean, you and I both know Europe is not a digital economy. Europe is an economy that values automobile production and, the financial life insurance, banks, and the financial services industry. So I think you have to see that pivot towards an economy that looks a lot like the United States. And I think at that time, you'll see the growth of growth equities within those economies. And I think you'll see capital flow there.
I want to give you a chance to talk about the quality momentum index that you developed. And do you consider that a strategy? Maybe you could talk a little bit about that and how you see that working in people's portfolios.
Sure. I appreciate that opportunity. So for many years, and again, understanding I'm a little timid, a little bit shy about presenting something to the public, I wanted to make sure that I had really strong confidence in the philosophy, the investment philosophy that I was presenting. But over the last, 10 years, I've had so many people come on CNBC and talk a lot about momentum. And momentum as a factor is very important in the market. Whether you believe that momentum is a successful factor for an investor or not, that I'll leave open for debate. But you cannot not acknowledge that momentum is a critical factor in investing. You have all these quantitative strategies. Well, what are they doing? They're observing the pattern of price over a prior period, whether it's 3 months, 6 months, 12 months, 36 months, or 72 months, whatever it is, right? So they're trying to identify, buy high, sell higher, technical confidence in price, which is a lot different than what we used to do, where we used to kind of look the other way and try and buy low, right? Find those value opportunities. But I kind of listen to this and say, but we need something more. We can't just study a bunch of stock charts that are going from the lower left to the upper right and think, well, that single factor is going to work. So what I wanted to introduce was the same type of confidence we were exploring for technicals. I wanted to introduce that with a fundamental criteria. So what was important to me is the study of the balance sheet, in terms of debt to equity, return on equity, and then looking at annualized sales growth, but doing it over a 3-year period, taking that, blending that together and valuing that equally with momentum, combining what I call quality and momentum. So the investment philosophy is quality momentum. It scans a universe of 500 US large cap companies. The first screen obviously would be momentum. We're narrowing down the list of 500 to 250. Then we're introducing the second factor, a quality fundamental balance sheet observation overlay. And by doing that, we're improving upon the 250 that we have. We're narrowing it down to 125 names, and we equally weight them. We wanted to equally weight them so we didn't expose ourselves to any form of idiosyncratic single stock event risk, and providing an opportunity where I believe we're dramatically improving upon a single factor of momentum. What are we doing, Ed? You've listened to me now for 45 minutes. I'm all about risk. That's exactly what I'm doing. I'm trying to mitigate risk when momentum goes bad. I'm trying to provide a shock absorber. And if you study momentum as a single factor year to date relative to our introduction of combining these two factors, you'll see there's risk mitigation contribution. There's the shock absorber effect. And I think ultimately that's a better product for the advisor community to be utilizing when they're looking towards a core portfolio holding for large cap equities.
Yeah, that sounds really good. You know, I know a lot of people are interested in those stocks that have good momentum, but from past research that I've looked at as well, momentum is great until it isn't, and then it drops off pretty fast. But I think that element of adding quality to it is a smart construction. Let me get your take on inflation. I've heard you talk a little bit about this. Let me just start out by asking you, what's your thinking on inflation and the prospect for inflation today?
I think what's important to kind of define is what's the response to a perceived or real inflationary environment, because that's going to come from monetary policymakers. They are going to have to respond to whatever ultimately we term the definition of transitory inflation to be, right? In a real life sense, it's pretty easy to define transitory. As it relates to the markets, that's far more difficult. So where's the response going to come in? I think the first place that people have to really focus on is the labor market. If you want to try and understand what the response is going to be from the Federal Reserve, then study the activity and the recovery within the labor market. And unfortunately, Ed, we are seeing an underwhelming recovery. We are seeing a recovery that has now been U-shaped in its nature since September of last year. It was V-shaped from May through August of last year. March and April of last year, we lost 21.5 million jobs. We got back about 10.6 million of those jobs from May to August. But since that, the recovery of jobs has slowed dramatically. You're still 6.5 million jobs short, right? 30% of the overall jobs lost. A lot of people have said, well, those jobs will come back when the government subsidies for the unemployed expire. I'm a little skeptical that all these jobs are coming back. I think more likely what has occurred is that because of the creativity, the efficiencies and productivity of this digital economy, a lot of those jobs have been hollowed out. So the Fed, I think, is squarely focused on the labor market, and they will accept this perception of inflationary pressures, cost inflation within the domestic economy. They'll accept that until they see a labor recovery that they view as more complete in its nature. I think a lot of the cost inflation that we are witnessing right now is domestically oriented. There has been, in the last 6 weeks, an import of deflation from the rest of the world. There has been a dramatic decoupling in terms of economic activity between the United States and the rest of the world. There's been disappointment in terms of the economic recovery, whether you're looking at Europe, whether you're looking at the emerging markets, clearly not performing with the positive trend that we're seeing here in the United States. And I think largely a lot of that has to do with the vaccination uptake and the better overall COVID trends that we're experiencing here in the United States. But understanding that there are some elements of inflation that are going to be real, like wages, understanding there are some elements of inflation that are reflected in the pricing of paper assets. That's real. That's going to remain constant. And understanding ultimately that until the Federal Reserve begins to pare back the size of liquidity that is being injected into the economy, while you could have inflation-friendly assets within your portfolio, I certainly would not give into the temptation of concentrating specifically towards a sustained inflationary environment over a multi-year period. And I also think the economic growth coming out of this pandemic have to very critically observe it and question whether we've reached peak growth from the recovery, which would be something that is more consistent with the economic recovery we experienced in the mid-'80s coming out of the 81-82 recession versus what a lot of people talking about, which is the roaring 20s, the ending of the pandemic that led to a multi-year period of above trend economic growth. I'm not sure that I see the evidence to suggest that. I think you're going to see a reopening that occurs once, a revival of economic growth, but we are going to decelerate that economic growth back towards trend through the course of 2022 and 2023. And ultimately, that might mean this liquidity that's in place stays in place far longer than we would think. So be very careful allocating or concentrating specifically towards an inflationary environment over a sustained period.
Because this is a podcast about trends, I want to ask you, what's one long-term trend you see playing out over the next year or several years?
Well, I think the dramatic participation from two generations at one time is something that is going to act as a catalyst. It's almost a investment renaissance period where over the next 10 years, and we'll play this back 10 years from now, I think you're talking about an S&P 500 closer to 15,000. I think that Gen Z and millennials combining together 150 million of them utilizing this digital economy is going to create the type of demand for paper assets and opportunity for ultimately there to be what's been missing, organic economic growth. We haven't experienced organic economic growth for a very long time. One could argue since the 90s, but we haven't seen that. And you've got these two powerful generations that are coming forward at the same time to potentially present that opportunity. Why is that important? Because if you study the history of bull markets, every bull market begins with the introduction of a generation to an economic cycle. They're being introduced how? They're formulating households. They're coming into their prime income generating years. And in the circumstances of now, because of the pandemic, they're actually beginning to occupy the metropolis, the big cities that are so needed in terms of the economic contribution geographically within the country. And then in addition to that, you've got the introduction, because of that wealth creation, of a generation to begin to invest. So if you study the bull market of the 1920s, well, it was the greatest generation that was the contributor. If you study the bull market of the 1950s, it was the silent generation that was the contributor. The boomer generation was the contributor to the bull market of the 80s and the 90s. And more recently, it was Gen X that contributed to the bull market coming out of the great financial crisis. But we've never had two generations kind of combining in force at one time, like we're about to bear witness to with Gen Z and millennials, 150 million of them. That's an overwhelming amount of demand.
How do the boomers retiring factor into that assessment in the future?
I think what that will do, in particular in a climate in which income is so incredibly challenged from an investment perspective, participation of monetary policy continues. The other part of that is understand, right? We didn't begin this abundant liquidity from the Federal Reserve and their participation during the pandemic. It actually began in the great financial crisis, and they haven't left since. The other part of that is that people don't realize in 2019, we were already beginning to lower rates before the pandemic even occurred. So I think you have to say to yourself, well, the Federal Reserve's been here since the great financial crisis. They've never been able to leave. Why are they going to be able to leave now? Especially if such as a dramatic economic circumstance like the pandemic. So for an older generation that's beginning to retire, I think they're going to have to remain committed to being invested in equities longer than maybe their parents or prior participants in previous decades have to the equity cycle. I think they're going to do it towards a lot of companies that are what we call bond proxies, or really are the mega cap technology names where you're seeing that sustained 20 plus revenue growth over a multi-year period. So I think that generation is going to have to kind of remain committed to the equity market longer than they expected.
In just the last few minutes, let's do trend or fad. I told you about that, right?
Let's do it.
All right. The term disruption, trend or fad?
Trend, but fad as it relates to the private and public market. That confuse you?
A little bit.
Yeah. So just real quick on that. I think there's been a lot of perceived disruption and disruptive companies that have hung around in the private markets far too long and attempted to transfer to the public markets and seen that kind of fail a little bit. I think the disruption in terms of the impact to an economy is real, but I think a lot of these companies, there's going to be a consolidation where you're not going to see the dramatic growth, whether it's in the form of a SPAC or a traditional initial public offering.
Impact investing, trend or fad?
Ooh, that's a good one. That's a tough one to answer, but I'm going to say trend. I think it could be a significant trend.
Alternative protein, trend or fad?
Trend.
Joe, this is awesome. Thank you very much for your time. I usually ask people what's the best way for people to find you, talk, or follow you. Just turn on the TV, I guess, and then
turn on the TV, turn on Twitter, and quite candidly on our website, Virtus.com. We have a tremendous amount of thought leadership in which I'm a significant contributor. I think individual and institutional investors would like what they would find there. So I'd encourage people to visit Virtus.com.
Wonderful. Thanks again, Joe. Appreciate it.
And thank you for having me.
And thank you for tuning in to another episode of Trends with Benefits.